represents Kotak AMC, and we're talking to him at a time when you look here, look there, look down, look up, everything seems to be at an all-time high. Gold, silver, US equities, Indian equities, NAV of Kotak mutual funds, everything is at an all-time high, right?
Yes, we are in a Goldilocks scenario where courtesy central banks printing money over the years have created a scenario where all asset classes are nearly all-time high.
They say too much of good news and too much of happy days don't last for long. So is this like a dream and we would be shaking up, or this is going to be a long dream which will keep us happy for next few years?
So difficult to say in a very uncertain geopolitical environment, Nipun bhai. If we see all around us, events are happening at a pace and a scale which is very, very difficult to figure out. There's no way we can position our portfolio for every global event happening. If we take a longer term view, the drivers for different asset classes are totally different. Gold is going up because central banks are buying gold to diversify their dollar reserves. Indian equity markets are going up because compared to other emerging markets, we look far better. Our earnings growth over next 3-5 years is likely to be in high single digit, low double digit. So my recommendation is that if you're taking a longer term view, then yes, there's no need to worry about this volatility. There will be nightmares, but if you sleep throughout, then you will have a happy ending. You will have a happy sleep.
Absolutely, and I guess one doesn't have to wait too long for the first litmus test, at least. The earnings are soon going to be knocking on the corners. But Nilesh, where is it that you're anticipating pockets of outperformance this earnings season? And where do you think underperformance is going to persist?
So purely from an expectation point of view, we believe some of the mid-cap IT companies will be able to outperform expectations. Now, please don't confuse numbers with the expectation. If a bed number is factored in and you deliver better than that, it will still be outperformance. Consumer discretionary, varying consumer durable is one space where we could see against earnings beating expectations. Banking and financial services, on a selective basis, we should see earnings beating out expectations. The disappointment probably is going to happen more on a stock-specific thing rather than sector-specific thing. Albeit real estate seems to be slowing down. The top end of the real estate is still continuing, but the mid and bottom end seems to be slowing down. So there could be some earnings disappointment over there. Correlated to that, sectors which are very, very competitive, for example, paints, there could be earnings disappointment. Commodities on a higher base may deliver slightly lower than expected earnings. So it's not likely to be large outperformance, large underperformance. It's likely to be range-bound earnings.
Right. Hi, good morning, Mr. Shah. This is Shrishti also joining in. But earnings is one key thing that the markets will be watching out for. But other than that, 9th of July, that's the deadline for the tariff that Donald Trump has said, and everybody is watching out for that. Give us some sense that how do you see the markets approaching this particular deadline? Because it's not just the Indian markets that are doing well, but US markets, they are also sitting at an all-time high levels. Do you believe that some nervousness can kick in as we approach that date?
So, Srushti, it's very difficult to figure out what Mr. Trump is up to. Don ko samajhna mushkil hi nahi, namumkin bhi hai. And markets by now would have surrendered, will rather wait for announcements and then react, then actually start expecting and then reacting. In some sense, Baghaya story is getting repeated. Time and again, the backtracking of announcements, backtracking of steps announced is probably convincing markets that it's better to react once steps are announced rather than in anticipation of the same.
Seems like it could be a no event for the markets, but definitely all eyes on that as Donald Trump comes out with a commentary rather every day. But also just wanted to have your take on back home when it comes to the Indian markets. You have given your take on IT as well as BFSI, but what about some of the other sectors wherein because of this whole tariff chatter, some of the export related sectors, be it specialty chemicals, pharma, these were actually beaten down names back then. Do you believe now is the time to once again look forward to those counters? Any valuation comfort wherein you find in some of these export related sectors?
So I believe both chemical and pharma are sector to accumulate. On the chemical side, we had capacities and we had capabilities. The Chinese competition was hurting our margin, and which is why operating leverage went against chemical sector. Now with tariffs, China plus one coming into play, our chemical companies' capacity utilization is going up, operating leverage is coming back, and suddenly they are able to deliver better than expected result. We saw that in March 25 quarter. We expect that to continue in June 25 and onwards quarter. In terms of pharma, Indian generic pharma provides about 40% of generic drugs consumed by Americans, and that costs them about 10% of their medical budget. So undoubtedly, it's a very, very cheap provision. We have seen that in some of the critical generic medicines, stock levels are running low, and clearly US would not like to disturb that equilibrium. More importantly, on this generic medicines, because there is oligopoly in US distribution, a large portion of profit is kept by the distributors rather than the manufacturers. Even if there will be levy of tariff, which we believe is not the front case, the distribution margin will be hurt far more than the manufacturing margin. Overall, we still believe Indian pharma companies is an opportunity to accumulate, just like chemical sector.
You were bullish on IT when we spoke a couple of months ago. You were bullish on cement. You were bullish on FMCG. Are those calls still intact? Those are contra calls, but are they still at play?
So in IT, Nikunj bhai, we are more bullish mid-cap IT companies where we believe they are leveraging AI in a faster manner and providing cheaper and better solutions to their customers. In FMCG, we are more towards consumer discretionary rather than consumer staple. Roti, kapda, makan, ab sab logon ne achieve kar liya hai. The focus is more on healthcare, on travel, tourism, hotel, QSR, those kind of experiential thing. We remain bullish on consumer discretionary because 1 lakh crore ka tax rebate has come into play, and that's recurring every year. Thereafter, there is EMI burden reduction thanks to 1% interest rate reduction. And finally, somewhere towards 2027 beginning, we should see 8th pay commission coming into play, putting money in the pockets of central government employees. Put together, this money in the pockets of consumers should result into consumer discretionary space moving more than the expectation. So we continue to remain bullish selectively on sectors like mid-cap IT, consumer discretionary, banking and financial services, chemicals.
Right. Nilesh, two phenomena which are playing out in the market. A, there's been a flurry of IPOs. I mean, as of last week itself, you had just over 20 IPOs, both main board as well as SMEs. The kind of valuations, A, that they're coming at. And then B, the other trend in the market, this promoter block deal and offloading of stake which is happening, and sometimes at a steep discount as well to the market valuations. What is it that you're making of that?
So one, we are thankful to the promoters and IPO companies because they are providing supply. If they didn't provide supply, we don't know whether we'll be in a position to buy the market or not. Second, again, in the IPOs, one has to be very, very selective. Just because an IPO of a company is coming, you don't go and invest over there. if there is a better version of that available in secondary market, why will you go into IPO? So be very, very selective in IPO. And now, fortunately, you have large number of IPOs coming. Not all of them are going to be successful. Not all of them are going to be value creator for their shareholders. Undoubtedly, as mutual fund, we are approached by every single IPO company. We have to put our resources and we'll have to work hard to pick up the right company. In terms of the promoter selling OFS at a sharp discount, well, that's the market. Neither we do favor to promoter nor they do favor to us. We have to come at a price which is fair, in our opinion, for a transaction to occur. Many promoters are undoubtedly divesting in the market, looking at their valuation. But a large part of that is coming back into the market via PMS, AIF, mutual fund, family office, direct investment. So in some sense, when you're looking at one side of equation, do keep in mind that there is a second side of equation also in play over here.
Fair point. Let's look at two differentiating factors. The differentiating factor, Nilesh bhai, between last quarter and this quarter is we've had good monsoon so far. Monsoons come early. The rainfall distribution has been great. Second is abundant liquidity. In fact, liquidity is now surplus. These are two factors which were not at play in the last quarter. Now they are at play in the month of June. When will the impact of this be visible in earnings?
So, Nikunj bhai, monsoon, while it is plenty, it's unlikely to come into play before December 25 quarter. July will be the month whose rain in terms of distribution, spectral distribution, as well as quantum will be very, very critical. By the time Kharif crop comes into play, it should be September to December impact, festival season and Kharif season output coming together. In terms of liquidity, while RBI is playing on the front foot in terms of providing liquidity, and they have inserted more than 10 lakh crore worth of liquidity in one form or other, the credit growth has remained in high single digit. It's not even in double digit. So liquidity is like water in the dam. That's very good. It gives confidence. But ultimately, water should flow into the tap. The pipe should be clear. And as long as we don't see credit growth picking up, as long as we don't see investment cycle picking up, the benefits of liquidity may not be as visible on the economy as one would like. But do remember, it's always important to have water in the dam and hope that it will flow into the tap rather than not having any water in the dam.
Mr. Shah, if I have to ask you that what should be the ideal investor strategy at this point in time, given that the markets are very close to their all-time high levels, Nifty Bank is trading at an all-time high level as well. What should be the ideal portfolio be like, given the fact that for the markets, the earning expectations are on the positive side. We are living in an uncertain geopolitical environment and very select sectors are giving you that valuation and growth comfort. What will be your advice to the investors?
So thank you, Shrishti, for asking this question. The first and foremost will recommend investors is to moderate return expectation. Last 5 years returns are unlikely to be repeated in next 2 to 3 years. Markets are fairly valued or little bit over fairly valued. And re-rating of market is unlikely to happen, which means your return from the market will be linked with the earnings growth. And earnings growth, in our opinion, is likely to be in high single digit, low double digit. So first and foremost, please moderate your return expectation. Number two, outside of equity, there are asset classes, REIT, InvIT, debt mutual funds, performing credit AIFs, precious metal index or ETF. Clearly, you need to diversify. Please maintain your asset allocation across debt, equity, commodity, and real estate. Don't put everything in equity because last 5 years equity has delivered great return. So follow the dharma of asset allocation and moderate your return expectation. That will be our recommendation to investors.
But Nilesh, if you had to really stick your neck out on which of these asset classes is going to be the best performer for the year ahead, which one is it going to be, you think?
So it's always difficult to take a short-term call on a one-year basis. But let me say that the expected return from all these asset classes over next 1 year is likely to be in a very, very narrow range. It's not going to be one is on the X side and other is on the Y side. The gap will be very, very narrow, and hence maintaining asset allocation becomes very, very critical.
Absolutely. Don't put your eggs in one basket and hunker down sizably your return expectations from equities definitely as an asset class. That's the word coming in from Nilesh. But Nilesh, so good having you on the show. Good to speak with you as always. Okay, let's move on and let's just check in on where the markets have settled in at and where is it that we are currently at after opening bell, and bring up the Nifty right now in trade for you. What